Well, so we continue to see a little bit of consolidation coming through, and I reckon that at the moment the Nifty is sticking around 23,500. And well, we've seen a lot of unwinding coming in as far as the futures concerned, a decline of around 13% in open interest here. Even in terms of the bank Nifty, we continue to see a decline of around nearly 11% in open interest coming in. And, we haven't seen as much traction there, though. And even though we are near life highs when it comes to the Nifty, well, it does seem like at the moment we're stuck in a little bit of a range. We've seen very mixed cues when it comes to the option market. In terms of your overall open interest distribution, the only strike that stands out is the 24,000 strike, and the 24,000 call specifically is where we've seen the most amount of our open interest distribution. But besides that, we have seen fairly evenly distributed open interest across the other strikes as well in terms of puts too. Moving on, if you consider the Fin Nifty, and which will look at our expiry today, where we're keeping an eye on 23,500 and thereabout. As you can see on your screen, there's a lot more traction with respect to calls as against puts, but of course a lot of that will change, considering today is the weekly options expiry. But in terms of stocks, again, a mixed day of trade. Well, we did see Bosch, IndiaMart, Exide, Dixon Technologies, all of them looking at short covering. And of course, Glenmark Pharma looking at longs unwinding coming through. But let's take this forward with our guest for today. Well, we have Amit Goel of Amit Ventures, who's joining us on the show. Amit, good morning. Thank you so much for joining in. What's on your radar today, and how are you reading markets?
Hi, good morning, Agam, and good morning to all your viewers. Thank you for having me again. The way I see the broad market indices, we've been, drifting on the upside, but a painful drift, if you ask me. Nifty has been trading in a broadish range of 450 points, with 23,200 being as a low of that range, and the new all-time high, which we had punched a couple of days back, 23,667. As a near-term resistance or a top. Yesterday's price action has been pretty bullish, if you were to ask me. And if somebody wants to take a bullish bet on the Nifty, one could look at initiating a bullish spread, keeping yesterday's low, which is 23,350, as a near-term or a technical stop for that. Right. Though I do not see a lot of breakaway action happening in the market, because on account of absence of any major cues. I believe near to the budget, we should be able to see some bit of action building up.
Amit, so you have about two different option structures based on certain conditions. Firstly, if you could tell us what the conditions are and under which, how would you deploy each of them? If you could tell us that.
Sure, Agam. So I'm suggesting that traders can consider Bank Nifty trades in the following manner. One is if we see Bank Nifty, following through yesterday's bullish close and trading above the 52,000 mark for at least an hour or so, giving some bit of comfort that okay, we are in a fresh leg of rally. One could initiate a bull call spread for the next week's expiry, which is the 3rd of July. In which we can look at buying the 52,000 call at that point in time and sell a lot of 52,500 call for the 3rd of July expiry. The profit target would be in this trade about 3,000 rupees, and we will keep a rupee stop loss of about 1,500 rupees. Margin in this kind of a trade is about 20,000 rupees, and this is a limited risk, limited reward strategy. This is only on a condition that Bank Nifty trades above 52,000 levels during the day for at least a couple of hours or so, which basically gives us some bit of confidence that yes, the market wants to open a fresh leg of rally. I do also have another trade if that does not happen. So if you allow me, we can discuss that.
Yes. So Amit, please go on. What is the other structure that you're deploying here?
Since we are at a very crucial juncture, like we discussed the last time I had come on board, suppose Bank Nifty does not break the 52,000 level. As a trader, I do not need to be set whether I want to be bullish or bearish. So what we could do here is, if Bank Nifty sees some bit of rejection, some bit of resistance building up at 52,000 levels, one could initiate a simple put ratio spread for tomorrow's expiry. This is a very quick trade. Here what we could do is we could buy one lot of 52,000 put for tomorrow's expiry, that is the 26th June expiry, and we sell two lots of 51,500 put. Now in this, the upside risk gets capped at about 550 or 600 rupees because this being a ratio spread. But again, because it is a ratio spread, the downside risk beyond 51,000 opens to an unlimited risk sort of a scenario. So the way we would like to play this is we aim for a target of about 1,500 rupees per lot, and there will be a special exit clause here. Suppose 51,500 is hit anytime during today or tomorrow's trading session, we will exit whether in profit or loss. Of course, if we enter this trade, we would not be exiting in a loss at 51,500, but that becomes a line in the sand that if it crosses below 51,500, which is our lower sold strike, I do not want to risk opening to the downside risk here. So this is if there is a resistance being faced in the market. So we're playing both the sides here.
Okay, well, so this is a relatively newer structure that we are talking about, and that's the ratio spread. As Amit has mentioned, what he's looking to do is looking to buy the 52,000 put, and against that, he's also looking to sell two 51,500 puts, and both these are of June expiry. That means that he's playing for the expiry coming in through tomorrow. Of course, he's also mentioned the conditions under which you can look to exit this trade. Of course, 51,500 being the key level here. So that's as far as, well, the other way to play the Bank Nifty is concerned, should you will fill in on the second condition that Amit has mentioned. Amit, on that note, going to take a moment to thank you for joining us and taking us through your views, as well as, of course, providing us these strategies going forward. With that, it's back to you, Tamanna.